Hi there. This time I am going to discuss profitability ratios. Profitability ratios would have to be a combination of liquidity, asset management, and debt management on operating results. If you see, there are a lot of things involved here because in reality, for a company to be profitable, it has to make sure that it has actually managed all aspects of the business, specifically its assets and liabilities. We have here five types of profitability ratios that I'm going to discuss later on. We have net profit margin, gross profit margin, operating profit margin, return on assets, and return on equity. So when we talk about net profit margin, it basically measures the percentage of sales that remain as income available to owners. So looking at the definition, it just makes sense that the formula is net profit divided by sales. Okay, because you're basically getting the percentage of what you earned that is available for the people who started the business or the owners. So we have here an example of an income statement to illustrate that. So I want you to focus on the values that we're going to use. So we have here sales, that's 6,400. And then the net income, which is 4,435. So these are the only amounts encircled because as we go back to the formula, as we remember the formula, these are the only values that we have to use. So substituting values in the formula, we get 69.30%. What does it mean? It means that for the specific year, the company has 69% of net sales that would be converted to net profit. On the other hand, the rest, which is 31%, are the expenses. Gross profit margin is the second type of profitability ratio. What does it tell us? It basically illustrates the profit of the firm, okay, in connection or relevant to sales. All right. Once we have already deducted the cost of producing the goods, the cost of goods sold. So we're going to use the formula gross profit divided by sales. So let's go back one more time to the income statement that I used as an example a while ago. So we have here the sales and we have here the gross profit values encircled because these are basically the items that we have to use in the formula. So substituting the values in the formula, we get 78.13%. How do we interpret this? It means that 78% of the net sales are actually converted to gross profit and 22% are cost of goods sold. Operating profit is the third type of profitability ratio. It assesses the operating income or earnings before income and taxes per peso of our sales or revenues. You can calculate it by dividing operating income by sales. All right, so kindly look again at the formula because that's what we're going to use in the next example. So we have here encircled the amounts for sales, and income from operations. So substituting the values one more time, we get 57.58%. So what does it mean? It means that the company has the companies has 58% of net sales, okay, converted to operating profit. On the other hand, the remaining 42% are made up of cost of goods sold and operating expenses. Return on assets, on the other hand, assesses the company's capability in getting a positive return when it uses its assets, all right? Or how effective it is to generate profit when the given assets are not available for a certain point in time. So we're going to use the formula return on assets would be equivalent to net income divided by total assets. So to further understand this, let's use the same example. So let's encircle the value for net income, which is 4,435, and this time, we're going to look at the total assets, which is 171,900. So it's important to know that when we compute for return on assets, we're not just looking at income statement. We're actually going to involve two types of financial statements here. We have the income statement and we have the balance sheet. So that's why if you observe, we encircle the net income value for income statement and we also encircled the total assets value in the balance sheet. So substituting the values in the formula, we get 2.58%. So how do we interpret this? We interpret this in this way. Okay, so every peso of assets generated 0.03 profit in 2020. So 0.03 is of course the rounded value of 2.58. Okay, so 2.58%, so the decimal form of that would be 0.0258. So you don't please don't get confused. So if you actually divide net income by total assets, you get 0.0258. All right, that's why it's 2.58% because you essentially multiply it by 100. But using the decimal form, okay, and rounding it, we get 0.03. That's why we interpreted that every peso of assets generated 0.03 profit in the said year. All right. Return on equity would have to assess the company's effectiveness in using its investment in generating profit. So return on assets a while ago measures how the company is effective in transforming its assets into profitable opportunities. This time, return on equity would focus on investment. So it measures how the company is effectively using its investment in creating or obtaining profit for itself. Okay, so this time we're going to make use of the formula. Return of equity is equivalent to net income divided by shareholders' equity. So again, we're going to involve two types of accounts here. One account from income statement, that is net income, and one account for balance sheet, which is shareholders' equity. So net income, okay, we get the value from the income statement, and the total owner's equity, okay, we get it from the balance sheet. All right, so pardon, this is not income statement. Sorry for overlooking this. This is balance sheet, okay? So total owner's equity would be 21,950. And substituting those values, we get 20.21%. And interpreting it, we say that every peso of equity generated 0.20 profit in 2020. All right, so take note of all the answers that we got from using the different formulas that I have discussed. If you don't remember them anymore, feel free to rewind the video and pause just to look at the different values that we were able to compute. So summarizing all the ratios, okay, it's important that you take a good look on all the values as a whole, all right? So we have here a table, we have the type of profitability ratio, the result that we get from using the formulas and how we have interpreted it, okay? So summarizing and looking at each aspect, we conclude therefore that the company is a highly profitable firm, okay, because of the high margins that we have computed. However, as mentioned in this interpretation, it is highly leveraged with a debt to equity ratio that is above the average industry standard. Okay, but it actually depends on the industry standard set for the industry that you are in. Okay, its high profit margin can offset its high degree of leverage. So I'm pretty sure before watching this video, you've already watched the financial leverage video that I have just made. So you know how financial leverage is also an important indicator of a company's financial health. Okay. However, it says here that although the company may have challenges in terms of setting its long-term obligations, there is a good profitability margin, okay, that it can use to settle that leverage, okay, that high degree of leverage. All right. So if you realize it by now, okay, it doesn't mean that the company is just good on a certain type of ratios. That's a good indicator of its success. No, it's not like that. You have to look at all ratios collectively. Okay, you have to put them together and then assess and conclude from the different interpretations per issue. Okay, so I hope you understand that. If again you have questions or clarifications about any parts of this video, just message me or use the questions or concerns tool in this module. Thank you.